Are you tired of your savings account barely keeping up with inflation? Imagine a steady stream of passive income funding your retirement, your kids' college, or that dream vacation. Today, we're diving into a strategy that's helped countless investors build wealth over time. High-quality dividend stocks paying yields of 5% or more. Whether you're a seasoned investor or just starting out, this video is for you. We'll break down 3 top dividend stocks that not only offer impressive yields, but also have the potential to outperform the market in the coming decade. Ready to put your money to work? Let's get started. But first, if you find value here, please support our channel by liking and subscribing. Now, let's explore the power of dividend investing. Did you know that over the past 5 decades, dividend-paying stocks in the S&P 500 have outperformed non-dividend payers by more than double? It's true. According to Ned Davis Research and Hartford Funds, dividend payers averaged a 9.17% annual return compared to just 4.27% for non-payers. Why? Companies that pay dividends often manage their cash more prudently, leading to more stable and profitable businesses. Today, we'll explore 3 exceptional dividend-paying stocks with yields of 5% or higher and the potential to outperform the market. Let's dive in. Our first pick is W.P. Carey, and ticker WPC. P. Carey is a prominent player in the real estate investment trust (REIT) sector, boasting an impressive portfolio of 1,291 properties spread across the US and Europe. This REIT employs a strategic net lease model, which shifts maintenance, insurance, and taxes to the tenant, ensuring a lean operation while generating steady cash flows. Now, you might be wondering why W.P. Carey's stock price has seen some pressure recently. The company made a bold move by divesting a significant portion of its office building portfolio, which led to a temporary reduction in its dividend. However, this strategic decision positions the company for stronger, more sustainable growth in the future. At current prices, W.P. Carey offers an enticing dividend yield of 5.7%. But here's where it gets interesting. The stock recently dipped below its 50-day EMA, but it could be poised for a rebound. Investors can use the EMA to track this stock's potential recovery as it shifts its focus toward industrial properties and warehouses, which now account for 64% of its expected annual rent. Additionally, the MACD indicator is useful here to confirm any shifts in momentum. If the MACD line crosses above the signal line, it could signal a buying opportunity. This, combined with the fact that W.P. Carey projects adjusted funds from operations (FFO) to land between $4.63 and $4.73 per share, far exceeding its dividend obligation of $3.48 per share, suggests a solid future for this stock. Another key indicator to watch is Bollinger Bands. If W.P. Carey starts trading near the lower band, this could indicate an oversold condition. Pair that with a MACD crossover, and you may have a strong buy signal. But before we move on to our next dividend stock, here's a quick question for you. If you could invest in only one sector of the stock market for the next decade, which would it be and why? Real estate like W.P. Carey, tech, healthcare, energy? Comment your choice below, and let's see which sector comes out on top in our viewer predictions. Next on our list is a household name in the telecommunications industry, AT&T, ticker T. Like W.P. Carey, AT&T has undergone significant changes recently, spinning off its media assets in 2022 to focus solely on its core telecommunications business. Investors should be watching for any positive trends by monitoring the EMA. Currently, AT&T offers a compelling dividend yield of 5.3%, making it attractive for income-focused investors. The business is deeply entrenched in broadband and mobile services, both of which are experiencing steady growth. One concern that often arises is AT&T's massive $126.9 billion debt load. However, AT&T's debt isn't necessarily a deal breaker if you track its MACD to look for bullish signals. The company's steady progress in debt reduction combined with its strong cash flow provides a stable foundation for long-term growth. Use Bollinger Bands to determine if AT&T is trading at an extreme. If the stock price touches or approaches the lower Bollinger Band, combined with a strong MACD signal, it may indicate a buying opportunity. This stock's investment in 5G infrastructure is another key reason to watch its momentum. Keep an eye on AT&T's free cash flow, which comfortably covers its dividend, and use the MACD and EMA to ensure you enter at the right time. This means AT&T has plenty of room for future dividend growth, especially if the stock's technical indicators align. Our final pick is Pfizer, ticker PFE. Finally, we have Pfizer, a global pharmaceutical powerhouse. Investors should be focusing on Pfizer's MACD and Bollinger Bands to catch any rebound opportunities. The stock has faced headwinds recently due to demand for COVID-19 vaccines and treatments, but that has created an attractive entry point with a dividend yield of 5.9%. Pfizer's underlying business is strong. When excluding COVID-19 products, the company saw a 14% rise in sales in the second quarter of 2023. Additionally, Pfizer received FDA approval for 9 new drugs this year, a record in the pharmaceutical industry. This diversification across multiple therapeutic areas positions Pfizer for continued growth in the coming years. EMA crossovers can give a clearer picture of when Pfizer is stabilizing after volatility, especially in its post-COVID product cycle. Watch for a 50-day EMA crossing above the 200-day EMA to identify potential upward momentum. The MACD can further confirm this trend by showing a bullish crossover. Bollinger Bands will also help you assess volatility here. If Pfizer's price touches the lower band, it could indicate an oversold condition, and combining this with a positive MACD signal could create a favorable buying condition. Looking ahead, Pfizer's strategic investments made possible by COVID-19 windfall have set the stage for a new phase of growth. The company's experienced global sales force is well equipped to market its expanding portfolio of drugs, potentially driving both revenue growth and dividend increases in the coming decade. Let's recap how these dividend giants stack up. WP Carey leads with a 5.7% yield, backed by a diverse real estate portfolio now focused on warehouse properties. Their projected funds from operations comfortably cover their dividend, hinting at potential growth. AT&T offers a 5.3% yield, with its massive free cash flow easily covering dividend payments. Their 5G and broadband focus positions them well in our digital world, but keep an eye on that hefty debt load. Pfizer rounds out the trio with a 5.9% yield and an impressive drug pipeline, including 9 new FDA approvals in 2023. Despite COVID-19 product declines, their core business is growing strong. Each stock brings something unique. WP Carey's stability in real estate, AT&T's telecom sector exposure, and Pfizer's pharmaceutical innovation. While all offer yields above 5%, remember to look beyond just high payouts. Consider each company's financial health, growth prospects, and how they fit into a diversified portfolio. As always, do your homework and consult a financial advisor to see if these dividend powerhouses align with your investment goals. In conclusion, WP Carey, AT&T, and Pfizer represent 3 compelling investment opportunities for dividend-focused investors. Each company offers a generous yield above 5%, backed by strong business fundamentals and potential for future growth. While past performance doesn't guarantee future results, these companies have demonstrated their ability to navigate challenges and reward shareholders over time. Before we wrap up, here's one last question to ponder. If the stock were an animal, what would it be and why? A bull, a bear, or maybe a chameleon for its ever-changing nature? Drop your best animal analogies in the comments. Bonus points for the most imaginative comparisons. As we wrap up today's video, remember that building a diversified portfolio of high dividend stocks can be an excellent strategy for generating passive income and achieving long-term financial goals. However, it's essential to conduct your own research and consider your individual financial situation before making any investment decisions. If you found value in this analysis, please support our channel by liking this video and subscribing for more weekly updates on investment opportunities and financial strategies. Remember, the information provided in this video is for educational purposes only and should not be considered as financial advice. Always consult with a qualified financial advisor before making investment decisions. Thank you for watching Simple Investing Secrets. Until next time, happy investing.